Last time I was here, we were discussing how Fridays are like 3-day weekends and people peace out on the weekend. So for you all to be here today, I really appreciate it. To Bruce Lee's point, we will be touching on some of the things that we touched on the last time I was here. And of course, if there's any questions, this is a discussion. This is not a lecture, right? We want to talk. So if you have some questions about some of the stuff that's going on in your financial situation, if I can help you, I definitely will. But today we're gonna kind of do kind of a hybrid. So my name is Tony Warfield, Financial Success for Veterans and Their Families. And the reason why I'm doing this presentation is because at one point in my life, I was actually an unhoused veteran, right? Basically, you know, I was able to live with family. I was able to live with friends, but I did not actually have a home of my own. And the indignity of, you know, serving in the military and doing everything that you can for your country, and then you come home and you don't have a place to, you know, lay your head, that's quite difficult. And the reason why that happened is it stemmed from some significant ignorance that I had financially. You know, I got out of the military, and right after I got out of the military, I went right into making a 6-figure income, doing very well. But then when I started investing my money, that's when I started losing everything. It's like I was so great at making the money, but I just did not know how to keep it. So one of the things that I wanted to do, you know, when I got back on my feet, was try to help other veterans not run into that kind of a situation. So for all of you that are veterans right now, I'm here for you. All of you that are not veterans, thank you for being here for our veterans, and thank you for taking part in this discussion, because this information it's not given freely. You know, this country basically preys on our ignorance financially. You know, we are, you know, forced to be consumers, and we're not taught the ways of money to be able to have the retirement income that we want, to be able to have the lifestyle we want, because we're so busy trying to catch up, and we don't realize that it's not catch up, it's not keep up, it's about thriving. And I'm hoping this information that we're going to be sharing today is going to be helping you figure out how to thrive with your financial situation. So again, I don't want to use personal names. I don't want to, I'm recording this presentation, so I don't want to record anyone's faces or your actual names. So I have mostly everyone's, I think, call signs. I think we had a couple of people come in. Sir, I think I don't recognize you. All the way in the corner with the glasses, looking way cool, because I think I want to get those glasses, by the way.
What happened?
I don't want to use your actual name if I address you, or if you were to communicate with me. So do you have a nickname or something that you would rather be called during this presentation?
Call me Davis.
Davis. All right, Davis. And the gentleman that just walked in,
Yes.
what's your nickname or
Call me Jack.
Jack?
Yeah.
Jack. All right, Jack. Yes. All right, and for everybody that don't know, I don't mind my name being known. My name is Tony Warfield, but my call sign in the Air Force was Warhead. It's because I was the bomb. And I always use that corny joke, and I'm gonna continue doing it. All right. So financial success for veterans and their families. So let's go ahead. Let me see if I can get this to work this time. Because last time it was a bit of an issue. So I actually have a financial literacy workshop that I do for, of course, veterans, young people, professionals, and other colleagues, you know, financial colleagues, depending on whatever industry that they're in. But when I do the 4-part series here, because of the turnaround, it's difficult to be able to go through this step by step. So what I'd like to do today is kind of like massage a few of the conversations in each module into this one module today to see if we can make it more of an efficient class, because we only have about an hour, maybe 75 minutes to be able to get through this information. Now, again, this is a discussion. This is not a lecture, right? So if you have any questions or you want to talk about something specific to your current situation, I'm happy to assist. If it's something that's personal that you don't want to share with the class, we can talk about that after the presentation, and just jump right on in there. So let's go ahead and get started. So growing your wealth, understanding the enemies. Before we start talking about that, the first part of this is growing your wealth. So income, employment, and I'm reading this to you because I know you can't see it. And what's interesting is neither can I, and I'm standing right in front of you. That's terrible. Don't judge me. Okay, so income, employment, Where does the paycheck go? Are you happy with your money habits, right? Handle your debt. What is your credit score? Keep your debt. Keep the debt that helps you grow. Cut the debt that drains your wallet. Pay what matters to you first, and then fund reallocation. And of course, today we're going to be talking about understanding the enemies of money, power of compounding interest, saving, investing, and retirement planning. And a lot of the other stuff is a little bit graduate level, but we'll figure out where everybody is once we have this, continue with this discussion. All right. So why is financial education important? Because there's no system in this country that's going to teach it to you. Did anybody learn financial education when they graduated from high school? You did? Man, what high school did you go to?
University High School in Irvine, California.
Really?
We definitely did a little bit of this. I think it was financial planning.
Okay.
It must have been they just set up a booth outside, and then we just walked by it. But those that wanted to stop and listen and do learn about it.
Mm-hmm. So they actually had a vendor that was invited to the school that shared the information, but was it a part of your school's curriculum is what I'm asking.
I think it wasn't part of it.
Okay.
But I think it was part of graduating. I think it was just save as much as you can.
Okay.
And then I think it was so they have banks, and this is just hey, we want you guys to just have a nice life.
Right.
Just this is about just getting ahead.
Okay.
Just saving a lot.
Okay. So that's great. And one of the things about college campuses, high school campuses, particularly the resource centers when you're coming out of high school, is you do get a lot of companies, banks, various financial institutions, other colleges that will come out and share that information with you or share the opportunity to gain that information. But for the most part, it's never really a part of the curriculum. You actually have to take it as an elective or something like that if you're going to college or even high school. Yes, Renegade.
Thank you. My experience with financial education is similar to going to seminars. I was at Fort Richmond High School.
Okay.
One of the best high schools in New York at the time.
Okay.
And yes, thank you. That was what we learned through seminars that we attended. But it was through the high school. They would always, sort of encourage us to attend those seminars when we hit our junior, senior years to find out about how to plan for college.
That I really appreciate you adding that. So, one very important point is that you sought that information, right? And that's great because how many people actually do, right? When we graduate from high school, college, a lot of people are not really comfortable with money. I got a chance to talk to a psychologist about money yesterday, and she made a comment that was very interesting. People who are not brought up in the ways of money, when they get access to that money, they don't know how to handle that money. And would it be fair to say that more than 50, 60, maybe even 70% of the population of this country fits into that category? So that's why so many of us fall short when it comes to making sure that we manage our money properly. Does that make sense? Yes,
The basic.
Davis.
Yeah, the basic principles of learning though will probably come from the parents, right?
That's a fact. But you gotta understand, if the primary source of learning is coming from the parents and the parents have not been taught that themselves, it perpetuates a cycle, right? So as that cycle continues to perpetuate, because every one of your children end up being parents and they never got that from their parents, so it continues to go through. So that's why it's incumbent upon the the educational institutions to be able to share that information, but they don't. Why? Because the United States is a business. And in order for this country to be in business, what's the purpose of a business? To make a profit, right? Well, in order for this country to be a successful business, it's got to make a profit off of its consumers. Who are the consumers in the United States?
Everyone.
The population. So the less you know about finances, the more money they can make off of you. It's not cool, but that's a fact, right? So particularly when it comes to veterans, the reason why this is important to me is because whenever you get your VA service rating and you haven't had a chance to learn anything about money, right? They'll take 3 months, 4 months, 6 months, a year, 2 years. But by the time they get done approving your claim, they're going to backdate when you actually have filed. So if it's 2 years, you got 24 months of payments according to whatever your rating is. And now they're going to give that to you in one big old huge lump sum check. And then you don't know anything about money. So what's going to happen? Who can tell me what happens to that money when someone, if they are not prepared for it, they're not educated in the ways of money, what usually happens to that money when it comes in? Yes, Davis.
It's like sand rolling through your hands.
It's like sand rolling through your hands. You know what? At least sand slows down a little bit, because for some people it's like water. I've heard stories of as low as $70,000 given. That's a reasonable amount, right? I've heard stories of $180,000 given, pretty reasonable. But I've also heard stories of $500,000 given as a one-time payment, and they continue to get additional payments after that every month. But can you imagine getting $500,000, not being financially educated, and a week or two later, you're dependent on the next paycheck coming in, which is down to maybe whatever your 50%, 60, 70% rating is? So if you weren't able to manage $500,000, what's going to happen with your 70% paycheck? 80%.
Like upon that gold chain.
Yeah. And chances are it's going to put you right back in the situation where you were, albeit maybe better clothed, but it's going to put you back in a better situation. So my goal is to make sure we fix that problem. We want to provide better options, reduce the number of people solely dependent on government aid, right? Super important to me. Reduce the hardships of working families, reduce the number of people retired to go back to work. I can't tell you how many people that are my age and above who have retired who feel they need to go back to work. And one of the primary reasons why they feel they need to go back to work is because when they're talking about their retirement plan, and this is veterans and civilians alike, when they talk about their retirement plan, they were given a retirement number. And that retirement, let's just say the retirement number is $1 million, right? Does anybody know the difference between a qualified retirement plan and a non-qualified retirement plan? Okay, so a qualified plan is money that has not been taxed yet. Non-qualified is money that has been taxed, or after-tax dollars. So the majority of these people who are getting ready to retire, they have retirement accounts that are qualified that haven't been taxed yet. So you think that you're going to be having $1 million when you retire, but after they tax it, how much you really going to get? Whatever your tax bracket is, right? You might as well just say 65% of that, maybe 60% of that. So $600,000. So if your retirement lifestyle was based on that $1 million, look at the adjustments you have to make when you find out you're getting 40% less than that. And then you talk about the Social Security that's being taxed also, because if you are depending on that, you have to be taxed on that as well. So, yes, Davis.
Okay, now you made a statement about being taxed on Social Security, right?
Yes, it's true.
But there are some situations where you don't get taxed, you're maxed out. So if you continue working, you don't have to worry about being taxed, right?
Well, it's a little bit trickier than that, right? It depends on what are your deductions. Social Security is looking at how much money are you actually making, and this is how much we're going to tax you. Now, there is a class that I can teach that they'll show you how to be tax-free with your Social Security. We're not going to be covering that today, but I can share that information with you, Davis, after we get done with this.
That's what I was told.
Right. It's true, but you have to understand how. See, a lot of times they'll tell you this is possible, right? A lot of things are possible, but how do I do it? If they don't tell you how to do it, it's a pipe dream, right? There's ways to do things, right? And we can definitely discuss that. So let me go ahead, because I will go get on one topic and stay on it forever, right?
So they probably lied to me then.
No, they did not lie. They might not have had the full amount of information, right? So if you were to look at this pyramid, you see a whole bunch of colors. So if I tell you that this pyramid is what is that, hot pink? It's not a lie, but it's more than just hot pink, right? So they might have just had a piece of the information. They shared that with you without fully understanding what the full disclosure of that information was. So we talk about managing our money, building a safety net, accumulating wealth, preserving wealth, and of course, leaving a legacy, right? So many of us, if we're here, we might have gotten into a situation where we are financially challenged. So I'm hoping to be able to understand how to get us from here to a place where we're in a more comfortable situation and we don't have to worry about couch surfing like I did for a couple of years, because it's not fun. Has anybody ever had to couch surf before? No, you don't have to raise your hand, but I mean, because I want you to understand where I'm coming from. It sucks, okay? And the reason why it sucks, can I have a personal moment real quick? So I'm laying on the couch and everyone's getting dressed. Someone, there are some people in the kitchen cooking. You smell all this delicious food, right? And now it's time to eat. Who are the people that get to eat if you're couch surfing?
The ones that are working.
So, come on, David. Did you do this presentation already? That's exactly right. I go up in there and try to get me a plate. I can't get nothing because this is for people with jobs,
Yeah.
right? It's important.
Like a non-productive individual.
That's exactly right. So it is essential that we make sure that we do what we can to make sure that we are productive. Does that make sense? So I want to be able to cover that. So we're going to talk about managing our money. And we're going to go through a couple of slides. So welcome. We're going to be talking about understanding financial basics, banking and money management, additional funding topics, right? And of course, inflation, taxes, risk, and financial institutions that you want to be able to use, right? So let's go ahead and continue that. So understanding financial basics, key concepts, budgeting, compounding interest, saving, and investing. Whenever you have a stack of money, what do you think is the first thing you should do with your money? What do you think you should do? Save. Why?
Invest it.
Do you think investing is first? Yes.
Have a financial plan with it.
Have a financial. I like that answer. Okay. So there's steps to way you do things, right? Investing is important because you want to be able to grow your money, right? But let's just say you got a cash of $100,000 and you decided you wanted to invest it in widgets, right? If you don't have a home, if you don't have a steady income, and you put that entire $100,000 into that investment of widgets and it crashes, you don't have a home, you don't have a steady income, and the cash amount that you had just got lost in the stock market, what happens to you? Yeah. So we don't want to start out with investing. We do want to get to the point to where we can, but we don't want to start off there, okay? So we want to talk about budgeting, compounding interest, saving, and then investing, right? Sorry about that. Okay, so, oh man, I'm moving too fast. Okay, how do you get this thing to go back? Don't judge me. How about that? Okay, so has everybody ever seen a budget sheet? And I'm not going to stay too long on this. Have you ever seen a budget sheet?
Yeah.
Show of hands have seen a budget sheet before.
My parents had one.
Okay, so not everybody's seen a budget sheet. Okay, bless you. Okay, so on a budget sheet, you're going to have all your expenses and all your forms of income. You're going to add up all your expenses, add up all your forms of income, and then you're going to put down the difference, and that's going to help you identify your discretionary income. If all your expenses are taken care of, after you've paid all your bills, everything is paid off, what's left over is your discretionary income. If you decide you want to do something with that, the first thing you're going to do is put it in some form of a savings fund, right? Why? Because you want to pay yourself at least 25% of whatever you're making. If you had a paycheck, I don't care where the paycheck comes from, whatever your source of income is coming from, you should pay yourself, because if that source of income is stopped, then you'll be able to live off the money that you had saved. Make sense? All right, so we want to definitely have a budget sheet, come up with the right discretionary income. If anybody wants a copy of a budget sheet, I'm happy to share. I got a few copies. If you need instructions on how to do a budget sheet, I'm happy to help you do the budget sheet as well. Okay? And so then there's compounding interest. Does anybody know the difference between simple interest and compounding interest? Well, you're gonna learn it today. So banks are basically giving you simple interest, right? So simple interest is you're earning interest on the principal amount of money in your account. Compounding interest is you're earning interest on the principal amount of money in your account plus the interest that is earned, right? So you have a situation where simple interest is 1,000 plus 100 equals 1,100. The very next month, you just get another $100. So now you're at 12, right? But when it comes to compounding, is if you're adding 10%, you're adding 10% to 1,000, you're adding 10% to then 1,100, then you're adding 10% to that 1,100, which is 1,210, and it just grows faster. The reason why compounding interest is your friend and your foe, I'm going to give you a couple of examples of how compounding interest is your foe. Car note. house note, credit card debt. All these different forms of compounding interest work against you. And what's so messed up about it is, anybody know what the top rate of compounding interest that a financial institution can charge you?
19,
I wish it was that low.
23.
I wish it was that low.
Man?
Anybody else? Keep going. I wish it was that low. The highest rate that I've seen comes from payday loan organizations, and they can charge you as much as 450%. That's a lot of money. That's why when people get caught into that cycle, it's so difficult for them to get out. So it's better for you to find other options rather than, use those. If you have the money, if the money is actually going to come in, then you'll be able to pay it off, but you have to pay it off immediately, because this is not compounding annually. It's compounding by every week. So you owed $100, but you paid them back $1,800. That's crazy, right? But as long as they got you on them, they're happy, because they're going to continue taking that money. They're not going to try to advise you on anything, right? So we want to be able to monitor how we're going to be using that money. And we understand compounding interest. We also understand how we can build our money using it. So how much money? Now, this is interesting. What did you say the credit card was? Last credit card I saw, on-time payment was 27.9. Payday loans, 450%. How much money do you get from a bank on your money, by the way? They're using your money. So how much compounding interest do you get from a bank? How much?
2%.
2% at best most of the time, right? But you do have high yield accounts.
0%.
Right? So we have what is called a rule of 72. Say you got $1,000, right? The rule of 72 tells you how fast it takes your money to double, right? So if the bank is doing 2%, you divide 2 into 72, it's going to take 36 years for your money to double. Is that fast enough for you?
No.
Anybody over 50 in here? So it's going to take me 36 years for me to have, the inflation is going faster than that, right? So obviously, if you're trying to grow your money, maybe a savings account is not where you want to put that, because it's not going to outpace inflation. Make sense? Or a co-line. So you have higher rate accounts, but if liquidity or something like that is important to you, we're going to talk about that right now. So let's get into the crux of this. Choosing the right bank, managing accounts, using credit wisely. We're not going to touch that today, but we're going to talk about bank selection today. Okay? So choosing the right bank. Do you need it now? The answer is yes. Place the money in a regular bank. No, you can put it somewhere else. Or if you will not need the money for a very long time, you might consider a high interest earning accounts that grow your money over time, like annuities, like certificates of deposits, right? So we're going to talk about those, right? So does anybody know what that is? Can y'all see that? Because I sure as hell can, right? So the 2025 VA disability rating, for those of you who are civilians in this room, the VA disability rating, they give us a certain amount of money depending on our rating status, anywhere from 10% all the way up to 100% employable and 100% unemployable. And it can be as much as a little bit over $4,200 if we have a family. It's a pretty good amount of money, right? And what's great about it is they pay you for the rest of your life. What's not so great about it is they make it almost impossible for you to get it. They will put you through the ringer to get it. And they do that to discourage you, but the money is available for us. So if you are a veteran and you have not gotten your VA disability rating, please apply for it, because that's your money, you deserve it. Okay? So that being said, this is very hard to see, but I wonder if I can throw this up. So this right here is showing, say 60%, right? So with kids, with spouse, you're looking at $1,700, right? $4,000 if you had 100% right here. This is $4,174 if you're with parents, no spouse or children. And then you have this next one where you see $4,317 if it's with one child and two parents. So you can see that's money that's coming in constantly. Okay, so again, I'm gonna talk about, you just applied for your VA rating. You usually don't get 100% right out the gate. They might get you as much as 70%. So let's talk about 70%, right? So at 70%, that's not the right one. Here we go. That's not where I want to go. If we were to look at 70%, right, they're going to be paying you. Man, this is going way too fast. So I'm gonna get it right, guys. Let me get it right. Well, let's go with 60%. So We're gonna look, oh, it's right here. Okay, $2,098. So $2,098, it took them 2 years to get you your money, right? So that's 2,098 times 24, 2,098, what is that, 50 grand? So 50 grand given to you in a one lump sum for someone who's not financially educated. Where do you put that money? Does anybody know? Let's find out together. Hi, Stretch.
Stocks, there's stocks.
Right? Stocks could work, right? So let's take a look at which account is right for you. We could talk about a savings account, certificates of deposit, or checking accounts. Which ones work for you, right? Does anybody have a savings account? Okay, does anybody have a certificate of deposit? Does anybody have a checking account? Great, all right. So earns high yield interest. Savings can, CDs can, sometimes a checking account can, but not often, right? Does your checking account earn high interest? It does? What? No?
Zero.
Does your savings account earn high interest?
Yes.
It does? What interest does your savings account earn?
Maybe 1%.
1%? The highest interest I've seen on a savings account is 5.84%.
Ooh.
You might want to reconsider where your money is.
Ooh.
Okay.
Yeah.
FDIC insured, all of them. ATM access, only a checking account, right? Debit card access, only a checking account. Debit card, that's when you're actually taking your money out. Check writing, checking account, of course. And fee-free withdrawals usually come with savings and checkings, not a certificate of deposit. Does anybody know what a certificate of deposit is? Stress, what is it?
CD.
It's a CD. What is it?
Like you took a cash or something like that, and you put it into a deposit and then you let it accrue interest.
Yes, and depending on how long you want that money to be in there, it could be anywhere from 6 months to 5 years. And the longer you put the money in there, the more compounding interest you enjoy, and it's usually higher than what you get in a savings account. Yes,
Yes,
Renegade.
thank you, Ward. I think the definition would be more like a bank note, pretty much like a bank certificate with a
Well,
certain bank.
Well, every banks might have them, but what is it? It's an investment tool,
Yeah.
right? So let's take a look at how to. It's no way. I really thought I was going to have that bigger TV, so I apologize, right? So high yield checking versus savings, right? Are they safe? Yes. Who offers them? Most likely a bank. Can you open multiple accounts? Yes. How many times can you transfer funds in a savings account? Usually no more than 6 times. Can checking accounts earn interest? Yes. How is a credit card different from a debit card? That's actually a good question. Does anybody know how a credit card differs from a debit card? Going once.
So you're saying a debit card and difference between a credit card. Credit card is something that is like basically the bank is giving you a line of credit or it's open establishing a line of credit or whatever. And a debit card is just is your own W-2, your own I guess earnings or whatever, your own retirement, your pension, whatever.
I love it.
That you put on your
Exactly right. So a debit card is your money, and a credit card is the bank's money or the financial institutions, right? So you've heard, use other people's money. Now you need to understand with a credit card, okay, it's basically a loan. So what do you have to do with loans? You got to pay them back. With your debit card, you have to pay that back. No, it's your money. The only way you're going to pay it back is by making some more money, right? Well, what's important about the credit card versus the debit card? If something happens and you were to lose the money in the account, the credit card company can handle that. Can you handle losing your money?
No.
So it's sometimes better to use a credit card if you have access to one, right? And also credit cards have benefits that you can enjoy, cashback bonuses, frequent flyer points, whatever. They got some bennies that you might not get with your debit card. Yes. Purchase protection. And purchase protection is great. I really love purchase protection because it wasn't me. I had a young lady buy $2,000 in Karen Spade purses. Do I look like I need Karen Spade purses? No. So they gave me my money back. I very much appreciate that.
See, that's a form of wasteful spending,
All right. Well, they bought them because they used my card and they sold them to someone else. Right? So I think that's an efficient way to do it. They stole it from me. 1 second, Bruce Lee. Yes, Renegade.
Yes, thank you, Warren. I always refer to credit as something to build your credit score.
Yes,
So credit card is a great way to build your credit score.
that's exactly right. And the higher your credit score, the less money you pay on stuff, right? Yes, Bruce Lee.
Oh, credit cards. What credit card? Is there a set path? Okay, I when I got back from the service, I don't know why I had like $100 on my credit in collections. I just bankrupted.
Okay.
The next lady was like, "Oh, you know, you're probably gonna see this again once in your life." So she taught me really well. I paid her like $1,000 just to. This time around, I bankrupted on my own. But is there a path where like you pick these? Just be very selective with the credit card. Don't just apply for any credit card that appears, and ask around and say like, "Oh, maybe that Inc. credit card. Who's that? Chase Inc. Maybe that takes about like 7 years to get with like excellent credit." And then maybe they say, "Oh, maybe get yourself a really small property for what you for what it's worth. Maybe like $100,000 like RV or something."
Well, you're talking about investment options. When it comes to this, selecting which credit card, it does depend on what your actual needs are. Again, what benefits does it offer? What interest rate does it offer? You know, some of them are great for transferring funds from multiple accounts to one account. And to your point, you don't want to just grab any credit card, because multiple credit cards actually helps your credit score, but too many credit cards can start to hurt your credit score, particularly if you have a balance, the total balance of all your credit cards more than 30%, right? So that's a credit class that we definitely want to talk about. So I want to talk about also is what about money markets? So money markets are, to me, they're kind of like glorified savings accounts, right? They offer you a higher rate of interest, which is great. But how do they differ from CDs? Is you have access to money market accounts allow you for easier access. It's more liquid. The minimum balance required is a little bit more flexible, and the risk level, both are considered low risk savings options, right? So then we're going to look at, so how does that money market different from a savings account? Because this is what most people might have, right? So interest rates, money market accounts often provide higher interest rates than traditional savings accounts. So when we start talking about investing, because we're going to touch on that a little bit before we finish, right? So when we start talking about investing, one of the things that you must understand when it comes to investing is you can invest by simply where you're putting your money, right? So, you know, Bruce Lee mentioned that a savings account usually does about 2%, right? Does anybody know what inflation is on average? Anybody know? Since 1914, inflation has averaged about 3.2%, right? So if your money is in a savings account doing 2% and inflation has been averaging 3.2%, what is happening to your money?
It's being taken.
It's getting weaker. And the dollar continues to get weaker. And you know that because every time you go to the store, have you been able to buy more stuff with that $20 or less stuff with that $20?
More.
You've been able to get more?
Yes.
Where the heck are you going?
Maybe like maybe 0.01% more.
You know what? 5-finger discounts don't count. Does anybody know what a 5-finger discount is? I just want to make sure I'm talking to the right room, right? So, you know, not that I've ever done that. No, I don't know. I've never even heard of it. Yes, buddy.
I have a good explanation for it, so we understand. Like, because of the wage increase. I mean, 20 years ago, I remember when I started working, I was making $5.15 an hour. Now minimum wage is 22. So it definitely gets weaker because with that $5.15, I was still able to get most of the things I needed. Right. But nowadays, I want to be able to get anything with $5.15. But even at 22 an hour, I still won't be able to get much because income taxes increase.
It's true.
The money they take out of it.
It's true.
So it definitely it makes the whole economy weaker.
That's absolutely right, right? So as the dollar continues to get weaker, it requires, and you understand the value of goods and services is still the same. It's not even, actually it's worse, you know, because they want to cut costs and everything. So, you know, food doesn't taste as good. I remember growing up, food was delicious. Now food is kind of what you have to do to survive, right? It's not really all that great, right? And a lot of the stuff that we enjoy, cars don't work as well. Remember, back in the day, we would want to work on that old Chevy, right? You'd be able to go and get into your own car, fix it, and be driving the same day. But if a car today breaks down, then you're catching the bus, the train, carrier pigeon, whatever. I don't know. So it ain't happening, right? So now because the dollar continues to get weaker and even the value of our goods and service continue to weaken, but the cost goes up because it takes more dollars to get those goods and services. So the money that you have in your accounts has to grow faster than the dollar is growing weaker. Does that make sense?
Yes.
So if your inflation is 3.2, then your savings account, checking account, or wherever your money is hiding needs to grow at a pace faster or higher at a higher rate than 3.2. So that's when you start looking at the kind of like the pre-me stages of investing, right? I want to invest, but I don't have a savings account set up yet. So, okay, let's look at the type of savings account that's going to allow you to grow your money as if you were investing. Does that make sense?
Yeah.
So that's when we start talking about the high yield savings accounts. And high yield savings accounts are absolutely essential because once you start making the extra money, you can actually start using that extra money to start other investments, start smaller investments. And we're going to start talking about that. But of course, before you start thinking about investing, don't trip. All right, that's my acronym, right?
Yeah.
So TRIP, T-R-I-P.
Yeah.
T stands for taxes. If you don't understand how to do your taxes, you're gonna trip. Risk. What you got to figure out what your risk tolerance is, right? If you got a bunch of extra money and you were to lose that extra money and be homeless, then you got a low risk tolerance. But if you have a bunch of extra money and you lost that money and your lifestyle doesn't change, then you can have a high risk tolerance. Usually younger people have higher risk tolerance because they have time for that money to grow back. I was a young person, 2001, in the dot-com crash, and I lost 50% of my income. That's more than 60%. That's more than 6 figures lost, right? But I was still young. I was still marketable. I was able to recover from that. Then we had 2008 housing market crash. I lost another 40%. Technically still young, I was able to recover from that. But you can imagine when I was couch surfing, I wasn't able to recover from that last little recession, right? So we got to make sure our money is in a position to where it can help us stay off of someone else's couch, right? So we want to make sure we watch out for taxes. If you don't have somebody that can help you understand taxes, get someone. If you don't have someone that's going to help you understand risk, what is risk? The potential of losing your money. You need to learn how to manage that properly. We want to start talking about inflation. We just touched on that, how important that is. And then procrastination is one that most people don't talk about. So let me throw procrastination at you, and I'm doing pretty good on time. So if you got an opportunity to make some extra money, it's right there. And they tell you got to act right now. And you say, okay, I'm going to think about it. And you take a week, a month, a year, right? Is the opportunity exactly the same as it was? Why Alpha 3?
Alpha 3.
That's his call sign. Why is that?
At first it might have been high, but now you waited so long,
Yeah.
now it's low.
That's exactly right. What happened in September, just last month? Does anybody know what happened last September? So every year,
Shut down.
it did, But in this particular situation, every 6 months or so, the Federal Reserve will adjust the rates, right? Last month, the rates went down. So when the rates went down, financial institutions start lowering their rates as well. So if you had an opportunity before they lowered those rates to make, say, 10%, but you have to act now. But if you wait till after the Federal Reserve lowers the rates, then you're going to get a lower rate. If you act now, you get 10%. But if you wait until after they lower the rates, we don't know what they're going to lower the rates to, but they end up lowering the rates to 7.5%, right? Housing market situation. A lot of people were getting some subprime loans and all this other stuff. And a lot of people were getting interest rates as low as 2%. And those people that waited ended up getting 4, 5, 6%, which is, it doesn't seem like a lot, but that's the difference between not paying an extra $100,000 for your house and paying $100,000. Not making an extra $150 in your savings account and making $150 in your savings account. So procrastination is very important for you not to do. If you have the opportunity to move forward, jump on it, right? So now to talk about something that Bruce Lee talked about last time we were here. I went through all that to get you all ready for this conversation, right? Because everybody wants to know about investing, right? If you have a VA rating, anybody in here 100%? No one?
I am on this bring yeah.
Okay. Are you 100% employable? It looks like you're 100% employable.
It's service connected, let's say, total and permanent.
Sweet. Okay. So if you're serving, are you able to save any of your money?
Right now, they both do. Excuse me, sir, apologize. I have to
Apologize to her. I didn't even notice.
They're like ever since since January last year, 2024.
Mhm.
I haven't had a bank. I had an active bank account, but they're not my benefits. I have like 9 months stacked up of basically DDB,
Mhm.
and so now that they haven't basically got it to me.
Mm.
So I don't understand. Like, I don't know.
So we need to talk to those financial institutions and make sure you get your money, right?
Yeah.
So my goal in this particular discussion is to help you figure out how to use the money that you have to be able to position that money to help you make more, right? So we have a situation where we talk about investment accounts, individual brokerage accounts, joint brokerage, Roth IRAs, which is like a retirement plan, traditional IRAs, rollover IRAs. You have, again, rollovers, inherited, custodial, and then, of course, college plans if you have kids to want to be able to save money for. So I said all that to say this. There are options available for you if you're looking for some way to invest your money in secured plans that have minimal risk, right? You'll be able to have a decent amount of return that outpaces inflation, and the money is still accessible, maybe not as much as a checking account, but it's accessible enough to where if you needed the money for an emergency, it's there, but it's in an account that's FDIC insured that'll allow your money to grow. So when you're not using it, any portion of that money that you have that you are not using, it's earning a compounding interest that is growing at a rate that is faster than inflation on average, because some inflation during COVID was like 7%. It was crazy, right? So does that make sense?
Yes.
Okay, so let's look at this, right? Financial asset protection. Now, of course, y'all know I'm not gonna do a presentation without giving myself a shameless plug, right? So my profession, my actual paying job is I'm a life insurance strategist. And a couple of the things that I know, you should be cheering, bro. I need some fanfare, cheerleaders, something. All right, so there's various types of life insurance that I offer, but the reason why life insurance is so important to me is because I did not have it when I lost my money. Had I had financial protections in place, I'd be a multi-millionaire right now. I'm still a multi-millionaire in here. But this guy right here, it's what does it say? It says Buffalo Soldier, but all this is a paperweight right now. Give me some time, right? So when you understand the importance of putting your money into the right accounts, you'll understand the benefits of growing your money at a rate that's better than inflation, right? So understanding life insurance will help you do that. But once you make the money, you need to keep it. And in order for you to keep it, because everyone's trying to take your money, right? In order for you to keep it, you need to protect it. So how do we protect that, right?
I hate that feeling.
It is terrible, right? So I talk about cash value life insurance, which is another form of investment. You can be able to save some of your money, right?
Yeah.
And then we also have I went too far, I'm sorry. Okay, here we go. Asset protection, which I really like, because a lot of people might have assets that they want to protect. So let's talk about how that protects them. Coverage for various assets. This insurance can cover a wide range of assets, including real estate, protect homes, rental properties, investments, your stock accounts, your savings accounts, personal property, business assets, and then of course, bank accounts, which shields savings and checking accounts from creditors. Is that important?
Yeah.
Okay, so if you get into a situation where someone tries to sue you and you got X number of dollars in your checking or savings account, and they try to take all your money, are they going to go after your checking or savings account?
Yeah, they go after whatever nowadays. They go after pennies.
They're gonna go after that. So if they're going, if now that's not to say you're in that situation, but if you ever got in a situation, you would want to be protected from them taking your money, right?
Yeah.
That's what that's for.
I know this is crazy, but this is, I don't know, I don't want to get into that.
We can do it. We can also talk about electronically exchange traded funds, right? ETFs. Does anybody know what a mutual fund is? Have you ever heard of an ETF?
Yeah.
Okay, so I'm gonna talk about ETFs. I want to spend a couple of minutes on this, right? Because a lot of people have been asking me about investing, right? But we want to be able to have a starting point. So again, the best starting point, in my opinion, is to identify a high yield savings account that gives you interest that outpaces inflation. And I've seen it as high as 5.84%. Now, that being said, those accounts are online, so you must be online savvy. Are they safe? Yes. Are they FDIC insured? Yes. Is your money protected? Yes. Does it offer you an interest rate that's higher than inflation? Yes. So that is your opportunity to start getting into, or basically birthing yourself into, investing. So when you start having additional money available after you've done your budget, so you have your income minus your expenses, if the difference between the two is a number that's greater than zero, that is extra money, right? Now that extra money could be $10, that extra money can be $100, that extra money can be $1,000, right? Depending on how you wish to invest, you can start looking at funds that are affordable. And those funds that you can look at are exchange traded funds, are a type of investment fund that is traded on the stock exchange, similar to individual stocks. They typically hold a basket of securities, which can include stocks, bonds, commodities, or other assets, and aim to track or outperform any underlying index. ETFs offer diversification and are generally considered a low-cost way to invest. Now, as veterans, we know our service connection money is going to come in, okay? But what happens with every dollar that you get in? You end up getting comfortable with that amount of money, right? Do you ever have enough money to do the stuff that you want to do? No. So what do we have to do? We have to find a way to increase our income. So when they give us the cost of living increase, last time, what was it, 2.5%? But inflation went up 3.2%. So technically we lost money on the deal, right? So we have to find a way to make this money faster. People that are interested in investing, you start out with a savings account, you got yourself a solid savings account, you build up an emergency fund, but then you start looking at low cost ways to invest, like ETFs, right? So what are the benefits of this? You can't read this, so I'm going to tell you. You get traded on stock exchange, typically passively managed, lower fees, investment minimums. ETFs have lower investment minimums. So what is an investment minimum? A lot of these bigger firms, they might want you to have $500,000 to start off with them. Charles Schwab is like that.
No.
Not to be putting anybody's name out there. But you might not have $500,000. You might have $50. Okay? And as funny as that might sound, I've seen penny stocks that start off at $1.38. And then you look at them the very next month, they're at $10. Now, $10, no, it might not sound like a lot of money to you, but let me tell you what that $10 is. So let's just say you had $1,000 and you were to buy a bunch of widgets for $1. How many widgets do you have? 1,000, right?
Yeah.
So when you bought those widgets at $1, you bought 1,000 widgets at $1 a piece. And next month, the price for those widgets is now $10. How much is your account worth?
10,000.
Yes. Did you notice I said account? I didn't say how much money you got. You notice that?
Yeah.
Is it how much money is in your account, or how much money you actually have? Does anybody know the answer to that? You know why I say that? Because that money is not yours until you do what? Not spend it. Say that again. Till you sell it. Right? So let me, I'm going to hang out right here for a second, because y'all want to invest, right? Anybody want to invest? Anybody thinking about investing, thought about it, dreaming about it? So I want to make sure this is clear. The money that's in the account is not the amount of money that you have until you sell the shares. We understand that.
Mhm.
So I don't care if you bought them at $1. If you bought them at $1 and they dropped down 50%, so now each of your shares are worth 50 cents a share. Did you lose 50% of your money? No.
No.
No?
Why didn't you lose 50% of your money?
It's a dollar.
Because you haven't sold them yet. Because what happens the very next month when the market goes up 300%? Now it goes from 50%, 300% of 50 cents is $1.50. So now you're at $1.50.
Yeah.
Do you have $1.50 worth of shares? I mean, are your shares actually $1.50? It's what your account says. But until you sell those shares, you don't own that money. You don't own the losses and you don't own the gains, right? It's only until you sell is when you own whatever it is. It's important for you to understand this because whenever you're looking at the markets, is that a whiteboard?
Yeah. How long do you do the dry erase? Yeah.
Dry erase. All right. I'm going to go off camera for a second. All right. So this is a dry erase board. So whenever you're in the market, you have a situation where you bought 1,000 widgets times $1, right?
Uh-huh.
The market goes down 50%. How many widgets do you have? No.
No?
The
The
one
market
dollar.
went down 50%,
1,000.
right?
Uh-huh.
So now I got 1,000 widgets times 50 cents.
Right.
But I still got 1,000 widgets. Did I sell any of my widgets?
Not yet.
So I still got 1,000 widgets. But in my account, those widgets are now worth how much?
$1.
Where here they were worth,
But it's already went down.
right? The market went down 50%,
Mhm.
right? So the market went down 50%.
Or 500.
And now your widgets, you still own 1,000 widgets, but now they're only worth $500. If you sell them, you own that loss. Y'all understand that?
That's a big deal.
What happens if the market goes up 50%?
It was another video, it's 1,500.
Okay, how many widgets do you have?
So 1,000, yeah.
1,000 still, right? You didn't sell anything. And the market goes up 50%. How much are my widgets worth, each widget worth? If the market went up 50% from right here, 50% of 500 is what? I'm sorry, 50% of 50 cents is what?
25.
25 cents. So 25 plus 50 is what?
75.
So now you're looking at your widgets are now worth 75 cents, right? Now your widgets, your account is worth $750.
Yes, sir.
So where people get in a lot of trouble is they think because the market went down 50%, it's going to have to come back up 50% for you to get back where you were. But 50% is 50% of where you're at, not 50% of where you were. We understand that. So in order for us to be able to recover from that loss, the market has to come back 100% to make up for the full loss. Does that make sense to y'all?
Yeah.
But you still have how many widgets?
Still the same amount of units.
It's still the same amount of units. Okay, now I'm going to ask you this question. What happens if the market, if the market goes up from here, if the market goes up 100%,
I'm gonna buy some more widgets.
oh man, you ain't lying, okay? But I'm gonna ask you this question, right? That equals what? If the market goes up 100%, what's 100% of 75 cents? 75 cents. So 75 and 75 is what? 150. Right? How much money is this account worth now? 1,500. Now I'm gonna mess your head up. In all those scenarios, you wanna stretch.
Okay.
You said you wanna buy some more stock, right?
Yes, sir.
When are you gonna, in that situation, in each one of those lines, when are you gonna buy more stock?
I'll probably buy it when it's, that's when it goes up, so you buy, so I mean, I guess it's
And
75, right?
I'm gonna give you this.
Oh,
No, wait, I ain't finished. Cause I want y'all to get this.
High.
I want y'all to get this before I leave. This is option 1, option 2,
I'm gonna buy option 1.
option 4. Show of hands of buying more stock in option 1.
Option 1 or 2.
Option 2, show of hands. Option 3, show of hands. Option 4, show of hands.
Oh, son. I'm on option 1, sir.
You wanna go with option 1?
Yes, sir.
Okay, so let me show you something. You don't know. Why don't you know? Because this is what makes investing so important. This is what makes investing so important for you to understand. That right there is going to help you. What is this called?
Investing.
What is that?
What is it?
That says trending.
Trending.
So you got all 4 of those scenarios.
Yes.
So if I ask you which one of those option 1, 2, 3, or 4, and I tell you that the market is trending downward, and you know this because you're watching it. You're getting the reports coming in every day. You see what the market is doing. If the market is trending downward, when do you buy more shares?
When it's rock bottom.
Which one of those is rock bottom?
Number 2, sir.
So yes, you'll buy it at number 2. But would you buy it at number 2 when you're still trending downward?
But if the company hands out the stocks when it's at number 1, what's your best thing to do?
Well, remember, you already own those shares. And that's what I'm trying to show you right now. You already own 1,000. You're looking at Stretch wants to buy more. Okay, so when is Stretch going to buy more? Is he going to buy more when the market's trending down or when the market is trending up?
Is there even such way to buy it like that? I think
Yes, that's why I'm pushing you
Well,
to
it
this.
depends on supply
I
and
think
demand.
It does do that. Yes,
Depends on
I think the
supply and
best
demand.
way is to go to the source and ask them.
yes,
Because when you're doing large scale, it depends on supply and demand as well.
it does. But there's another factor that I want, and this is really easy for you to do.
I just basically money spending.
Really easy. It's strange, but it's really easy. What are they asking you to do?
Just keep your mouth closed about this stuff.
Pay attention,
Preserve
because
wealth.
this is important. Whenever you hear about a stock, a particular stock, and you got them losing their minds telling you to buy, what should you do? Should you buy?
Buy.
Who says buy?
Buy.
If all the experts are telling you, yelling and screaming, we need you to buy, should you do it?
No. Wait for it to hit rock bottom.
That's when everybody drop out.
Is it MC? Is it MC?
Yeah,
Yeah,
eventually
yeah.
when they tell you to buy,
Your
the
name,
rate's gonna
which
go
one?
down.
KB. What did you say?
People buy.
You want to,
So
you're
for-
just saying buy, you actually want to sell,
Yeah,
right?
it's
Why?
buy.
Why? Come on, tell me why.
It's telling you to buy at number
Yeah,
1,
this doesn't make you
so
sell.
you're definitely gonna buy.
See, check this out. Check this out. Whenever someone, if I want to sell you something, if I'm the one that owns all these shares,
Yeah.
and I really want you to buy them, I'm going to get all my people, all those announcers, radio people, and everybody to get them to tell you to do what? I want to sell them. And I'm going to get them to tell you to do what? Buy them.
Promote it.
But if I'm telling them to get you to buy them, when am I telling them pay attention because you don't like this. When I'm trying to get you to buy my shares, when am I trying to get you to buy them? 1, 2, 3, or 4?
2. Oh, selling is a.
I'm trying to sell them.
4.
So when do I want you to buy them?
4.
4. When I want to buy them back,
Yeah.
when do I want you to sell yours?
2.
2. You're the consumer, Stretch. When do you want to start buying these?
I guess when it's like 2 or something.
I'm gonna show you when you get there. So what's gonna happen is, you're gonna see this happen.
550 as low as like a 75 or 25.
Trending is the best.
Tell you when it gets higher.
That's it right there.
Yeah,
You're never gonna get that.
no.
But when you see this break and start going back up, that's when you wanna do it. And that number has to be lower than whatever numbers you had in there.
Thank you.
That makes sense?
That's very excellent news. Thank you, sir.
You got what I'm saying? If it's the same and it's not doing anything, then why are you looking at it? It's not going. Why are you listening to it? But if it's trending upward and it hasn't come from a bottom yet, if it's trending upward and it hasn't bottomed out, then you're gonna end up paying this instead of this. So you're gonna be paying more. Now, does that mean you don't buy? Because what happens is, even at this number, because it's growing so fast, you might want to go ahead and buy that, because guess what? This number is going to end up being this number.
Damn.
Because it's trending so strongly.
Yeah.
So you're getting it at a discounted rate,
Yeah.
right? Even if it's more than what you paid before. But in order now, does that seem pretty easy? It's pretty easy because it's on that whiteboard, right?
Yeah.
But when you are looking at all these different companies and you're looking at these ETFs and these mutual funds and all these stocks and all these bonds and everything that's going on, it's a lot of stuff going on.
Yeah.
Okay? So because it's so much stuff going on, you need to understand that there is just as much as that money can go up, what else can that money do? It can go down. So earlier in this conversation, I'm gonna bring this home for you because it's about that time. All right? Earlier in this conversation, we talked about a budget sheet, right? If you don't understand that like a professional, you need to hire a professional. And if you decide you want to use any of your money, it had better be the money that you're going to be using after all your expenses are covered. It had better be the money that you are using that does not include, and hear me when I tell you, because I talked about procrastination, right? I want you to take advantage of this opportunity right now. It's important that you take advantage of this opportunity right now. You got to do this opportunity right now. You get all excited because I'm saying it like that because that's how they send the messages to you. They're trying to excite you. So now, if all you have in your account is your rent money, but you got to get this company, you got to do this, you got to jump on it right now. Do you use your rent money?
No.
I'm in the right class. Thank you very much. Because too many of us will use that rent money and all that hype that they heard that they told you to do was designed to get you to buy it at $1,500 when you could have got it at $500 if you only just waited. Or you would have got it on the ground floor. All the stuff that they say. So meanwhile, you're using money that you cannot afford to lose to invest in something that you know nothing about. Do you understand what I'm saying?
Yes.
And the second that you do that, you'll be couch surfing. Are you with me? So this is why it's so important that you make sure that your money is secure. Your living situation, your financial situation is secure. Your home is secure. And if you can afford to lose what's left over, then you don't care.
Yeah.
But if you can't afford to lose the money that's left over, then we need to make sure that your money is sitting in accounts, right?
Yeah.
We need to make sure that you got your money sitting in accounts, savings, CDs, or whatever, that you don't have to worry about losing that money. That savings account that I talked to you about, that's sitting at 5.84%, it's 5.84%. You're not going to lose money. It's outpacing inflation. If you can't handle that, you need to put that money into an account that you can handle. And once you get used to that, then you start graduating into other accounts. Does that make sense?
Yes, sir.
And then as soon as you start graduating in those other accounts, obviously you're going to have the extra money to do so.
Yeah.
So let's look at your service rating again. Is that 100%? Okay, so let's just say your disability rating was 70. What's 70? I'm blind as a bat, I'm sorry. Your disability rating is 70, it's just you. Only one child, no spouse. 70 is $1,858,
Wow.
right? It's $1,858. You're used to $1,850. Your budget is for $1,850. You went ahead and got you another a reassessment of your disability, and now they put you at 80%. Now you're making $2,158. That's exactly $300 a month more. What do you do with the $300?
Invest.
Before you answer.
Invest.
Before you answer.
Invest it, sir.
Before you answer.
Invest it. Save
If
it.
you were used at $1,858 and you had credit card debt, what do you do with that extra $300?
Save it.
Save it.
Why?
Because you want to accumulate as much savings so you can purchase.
The answer to that is yes. And the reason why I use credit card debt specifically is because what is the interest rate of the credit card versus the interest rate of your savings account? If your credit card has an interest rate that's higher than your savings account, you need to get rid of that credit card right now. So if they give you an extra $300, you use that $300 to get rid of your debt. And as soon as you get rid of your debt, your FICO score goes up. You mentioned, Jack, you mentioned the FICO score, right? Your FICO, oh, I'm sorry, was that Renegade that I mentioned that? Yeah, Renegade. So your FICO score goes up. Your FICO score goes up. You pay less for stuff. You pay less for stuff. You got more discretionary income coming around. Now, what can you do, Bruce Lee?
Buy something.
You can start investing. But you got to make sure home is situated first, right? So this last 5 minutes, I'm going to talk about this. This is not your home.
No.
This facility is not your home. This facility is not your home. This facility is not your home. Okay? This is a way station that's giving you an opportunity to make some choices that'll benefit you for the lifestyle that you choose to have in the coming years, your next chapter. And while this is giving you that chance to look at new options, it's also giving you a chance to learn how to navigate those options. Because does anybody know the difference between a dream and a goal? When do you dream? And most of us are sleeping through life right now. A goal is something that you set and you find a way to achieve it. You find a way to achieve it. So my goal is to help you identify your financial goals, and then we're going to map a way to achieve it. If your goal is to invest, you got to make sure everything else is taken care of first. So let's take a look at this. And this is how I'm going to close. So we're looking at these pyramids right here, right? Managing your money, focusing on daily expenses, reducing debt, establishing a stable cash flow. Your VA rating will do that, right? Then you have creating an emergency fund, growing your savings, and protecting yourself with insurance. I'm gonna die. You know I'm gonna get my play. It's gonna happen, right? Then growing your investment profile, saving for retirement, and then utilizing tax-efficient investing. And then we're gonna be talking about the next level ones. But getting out of here is the goal. Staying out of here is the lifestyle. Does that make sense? Yes, Renegade.
Yes, I have a question. What I just had to say that everything that we learn through handling money is always to save.
Yes.
This is all new to us now to buy.
I'm not saying buy as a consumer.
Because they say you have to read the fine print of everything.
Right.
So would you say is it still a risk to put your money in the market rather than keeping it where it's safe?
That is an excellent question, Renegade. So I'm going to answer it like this, because earlier we were talking about trying to understand when to buy or when to invest, right? And you're right. They're always trying to push us to be consumers because they got something to sell. Anytime you hear somebody trying to sell something, they want you to buy it because they don't care about you saving anything, right? So, but when do you actually invest? Again, you want to make sure you have the means to do so. And when you have the means to do so, you need to identify what type of investing you want to do.
So what's the number? What do you say was ballpark for in California based on cost of living and your budget of, say just to have a car and an apartment, your paycheck is already, and then you have to save to get a nicer car, right? So what would you say that the minimum will be to really think about investing? Because I'm thinking about investing and making that dedication.
I'm going to say the minimum is whatever you have in addition to your expenses being paid. That is what it is. And that's because there's no finite number, because my living expenses are not your living expenses. right? You can put a percentage on it, right? Say 5%. My 5% might be different than your 5%, right? But what I can tell you is you got money coming in, you got money going out, and whatever's the difference is what you can use to maneuver.
Okay.
If you don't have any money left over to maneuver,
'Cause I have a job, I have a job myself.
excellent. Yeah.
Yeah, I
So,
work from home.
but with that job, right? Because I turned the slide off. With that job, you see all your deductions, right? You see all your deductions.
Yeah.
You need to start looking at those deductions on your paycheck and find out what you can reduce. Because those deductions would include garnishments, certain types of taxes. A good example of tax deductions, right? So right now, it takes about 5 months for you, if you have a job, regular W-2 job, it takes about 5 months for you to pay your taxes. If you were to quantify it over the course of a year, if you were to just add it all up and just put it in terms of straight time, it's about 5 months. So you get 7 months of your money and they're gonna take 5 months of it from you. More than half of your money is being taxed, like bang, it's gone, right?
Okay.
So what we wanna do is we wanna reduce the amount of money that you have to pay in taxes. How do you do that? You increase your deductions. Well, Tony, how do I increase my deductions? Well, there's a couple of ways that you can do that. You
Buy
can
an
have
asset.
you can buy assets, right? But they have to be assets. But the best way to reduce your deductions, right, is have a way to make sure that the income that you're bringing in is not being considered for that taxable year. Okay, so when we start talking about retirement funding, let me see, have you guys ever heard of a 401k plan? You've heard of various retirement plans, right? These retirement accounts, Roth IRAs, traditional IRAs, rollover, inherited, whatever. That money, whenever it's qualified money, qualified means the money that is in your account hasn't been taxed yet. So if they're taking that money out of your paycheck before you get it, that money now reduces your taxable income for that year, right? So if you get paid $10,000 and $1,000 of that is being taken out before you get it, they're only going to be able to tax you on $9,000. So that lowers your taxable income, right? What's important about that is that $1,000 can make the difference between you being taxed at this bracket or this bracket or even this bracket. And as you get older, it's essential that you understand that, because do you think the taxes are going to go up when you get older, or do you think they're going to go down?
Because
They're
now
gonna
they're
go
raising the rate of Social Security. So that means we're gonna actually pay more taxes as we get older.
Absolutely, and we shouldn't even have to pay taxes, but that's another conversation. That's another dinner, right? So if your taxes are going to go up, what's going to happen to your deductions when you no longer work? Are you going to have more deductions, or are you going to have less? You're going to have less. So if the tax tables are already showing the taxes going up, KB, they're going up, bro, right? The taxes are already going up, and now your deductions are no longer available. That means you're going to pay that much more in taxes when you retire. That means you want to make sure your money is in an account that's going to allow you to still be able to have enough money left over to be able to absorb all that deduction, all that loss, right? And you have to do that early on. Even if you're already in your 50s, even if you're already in your 60s, you can still make adjustments, but it has to be now. You can't procrastinate, right? Because the alternative is couch surfing. And if you know me, it ain't no fun, right? So does anybody have any questions? Thank y'all. You guys are I think you guys are the most interactive class we've had since we've been here. So thank you. My hands off to all of y'all, right? And my guy, Bruce Lee, left. All right, did you have any questions? Your name is Mike, MC? Oh, did I get you?
I was known as Doc.
Doc.
Yeah.
Doc, I'm gonna put your name down there, Doc.
Did you sign
All right. I hope that made sense to everybody. There's no questions? All right, next, I don't know about next month, because next month is like Thanksgiving, right?
Yeah.
It's still, I think it's still the 21st. The 28th is.
Am I gonna be here?
Thanksgiving is the 28th week, but you're the 21st.
Am I gonna be here on the 21st?
I'm trying to have.
Okay, so everybody that's here, if I'm gonna be here on the 21st, make sure you show up because I'm probably gonna have something special for each of y'all. Okay, I like to give gifts during the holidays. I don't know if I'm gonna be here for Christmas, but because you guys did so great in this class, we are really gonna have, I hope y'all ready for this because we're gonna go into some stuff because I can actually show you how to actually put some of your money into a way for you to invest so you can start making some more money. If y'all interested in talking about that. Are we interested in talking about that?
Email? You have an email?
I do. Is it, it's not on there?
No.
I'm sorry.
I just got your email. It's up to you if you want to answer it.
I'm happy to answer.
Put your name on it, I'll go. Thank you.
Next week is the wellness groups, where she's gonna talk about mental health stuff.
Good to see
emotional
you.
feelings and all those different things.
Can I get one of those
They're
cookies?
gonna be here.
Grandma
after
cookies?
what they say.
Yeah, they're delicious.
You got it?
Oh, yes, sir. There's only one left.
Gotcha.
Is the wellness.
All right.
I'm trying to get money, and trying to get some money to help fix the house.
I'll figure it out.
Don't stay with my office. I'll pay for it.
Okay, that's even better. Okay, let me go ahead and close this out. All right, for those of you who may be watching, thank you so much for your time for joining us. Today was a very, very special class. We're out here at US Vets in Inglewood. I should have said that in the onset of this discussion. If you get a chance, check out the presentation, check out the, share it with a few friends. If you have any questions, put the questions in comments. And with that, I say thank you very much and enjoy the rest of your week, month, and year. Talk to you soon. Bye.
That's good.
You can, no.
You sure?